Good morning. David Dietz here. Who am I? I'm President, Chief Investment Strategist of Point View Wealth Management. We are delighted to have you joining us on this webinar on this Thursday morning here. We're just waiting for some people to arrive. So we're going to talk a little bit about what's going on in the market now, what has done very well, and where there might be some opportunities. I want to do some housekeeping here. One would be that we do look forward to answering your questions. We've got about a 20 to 25 minute presentation, and we're saving about 10 minutes for questions. How do you ask your questions? Use the Q&A that you should see at the bottom of your screen, and we look forward to answering all those questions. We also have a poll. So the question is, what asset class do you think has the most value right now? And you've got 4 choices. Pick one. As soon as you do, then the poll visual will go away, and we will share the results with you at the end. Fortunately, I am sharing this show with our very own talented Donna St. Amant. Donna is Managing Director and Portfolio Manager at Point View. She helps our clients work on everything to do with their portfolios, construction, implementing the investment strategy, and the management. She's a veteran of the investment world, over 40 years working in the financial industry. Prior to joining Point View, she had senior positions at both Bank of America and Merrill Lynch. Donna received her MBA from Columbia.
Because first I need this to go. Did he send an email?
And her undergraduate at Villanova, works with many different nonprofits and charities around town, lives in Summit. So with that, Donna, take it away here.
Okay, great. Thank you very much, David. Just first, for those not familiar with Point View, just a few highlights. We are an SEC registered investment advisor based here in Summit, New Jersey. We are part of PPAC Private, the wealth management division of PPAC Gladstone Bank. And we provide customized investment management and holistic financial planning services. We manage for tax efficiency and transparency, primarily using individual stocks and bonds. We have a $500,000 relationship minimum and a 1% annual fee. Or you could also take advantage of just our financial planning analysis for a flat fee. And we custody our assets at Fidelity. Flip this slide. David, you want to flip the slide there? Move forward. Point View has received some national recognition. A few of these are shown here. So to kick off, we want to look at where we are today. The financial climate is surreal. We have experienced the worst recession and the highest rate of unemployment since the 1930s. The world is enduring a devastating pandemic, yet through all of this, as we enter September, we see record levels in the stock market. Chart 1 on the right there is the 1-year unemployment rate through August. You can see the spike in March. Fortunately, it has come down, but we're still experiencing a high level of unemployment. Then you see in chart on the left, in chart 2, year-to-date performance for the S&P, which recently surpassed levels from January. And now, although we have fallen a bit this month, we're still up kind of slightly from where we were right at the start of the year. And we had experienced this, huge kind of comeback. But if you look at this next chart, you can see how much of that S&P performance can be attributed to just 6 stocks, the FAANG stocks: Facebook, Amazon, Apple, Netflix, Google, and Microsoft. These constitute 25% of the S&P value. Their valuations are very high, and the S&P is a market-weighted index, so the stocks with the higher market cap will carry a higher weight in the index, meaning the higher these go, the larger the exposure in the index. It really makes the index look expensive. Now we have started to see some underperformance this month, which this may continue. And there is a risk that these firms that have seen such a surge, it leaves them open as possible targets for regulators and for their competitors to be aggressively targeting their market. So looking at September, this month we have seen a pullback in the market, down 5+% as of last Friday, and now down over 7% as of yesterday's close. So it is not too surprising given how fast the market came back and that there are many points of uncertainty pressuring the markets right now. We have, the concern, as we've been saying, that the market is overvalued, particularly those mega cap stocks. There's still COVID fear as we enter the fall, with hotspots still popping up across the world, and news of the timing of a vaccine seems uncertain. The latest COVID relief bill has failed to pass, and it seems less likely that something will get done before the election. And then, of course, the election itself, as it draws near, the worry continues to build over the outcome. So the market is unlikely to rally weeks before the outcome is determined. And then, of course, we also have ongoing tensions with China and no new monetary policy. So a lot of things, a lot of uncertainty that are pressuring the markets right now. So where does this leave us? We really need to look to other areas of the market to find value. Despite the recent volatility in September, valuations of the large cap stocks are still overvalued, and they're commanding such a large influence on the major indices like the S&P 500, the NASDAQ, the Russell 1000. So we need to look for cheaper asset classes. And we recognize that attractive valuations don't always line up with timing, but over the long term, it can be the best indicator of returns. So we've shown this slide before, and it tells us from top to bottom what has been the best performing asset class from year to year. So the orange squares represent large cap returns, or the S&P. So this is at the top of the pile in 2019, and it's the best performing asset class year to date. But it's not always been the case if you look where the orange square falls on the chart from year to year. Attractive asset classes right now include international equity, small cap companies, and value stocks. So take a look at international stocks in gray on the chart. In the past 10 years, international stocks have underperformed the S&P in all but 2 years. This was not always the case. In fact, if you look farther back to 2006, 2009, international stocks outperformed the large caps in all years except 2008. Small cap companies, which are represented in the chart in blue, have also outperformed the S&P in many years, yet they've underperformed in the last 3. So sectors really should be considered when they're out of favor. So now we're going to take a look at each of these sectors in closer detail and give you some ideas how to add exposure to your portfolio. International stocks. Here we look at the relative performance of domestic versus international in this line here. So over the past 10 years, domestic stocks have beaten international by almost 11% per year. But that has not always been the case. So in the chart, you can see the cyclicality of this relationship. So why is domestic outperformed? One reason is that the US dollar has appreciated significantly. This reduces the value of non-dollar denominated stocks and their earnings. The US has a different market composition. The US has a greater weighting of tech and healthcare versus non-US markets, which have more financial, energy, basic materials, and telecom. And tech, as we've been saying, has outperformed over the last decade. So given that US tech may be overvalued right now, this trend could turn. Another reason for outperformance in the US is greater earnings per share growth, partly due to an emphasis on share buybacks. And then finally, the US financials have outperformed overseas financials. So the question is, will international stocks begin to perform? The timing is, of course, uncertain, but the valuations really suggest that international stocks should provide better returns in the future. So looking at the chart here, this shows the stock indices in Europe and Japan, along with the return of the S&P for 1 year and then for the past 10 years. You can see the S&P in the past year has returned almost 15% versus Japan at 4.5% and Europe negative 3.1%. 10-year numbers similar. Then if you look at the PE for the S&P, 30.7 versus 18.8 for Japan and 15.6 for Europe. Also, if we compare the Vanguard Total International Stock Index, that's the VGTSX, with the Vanguard's US index. The US yield is just 1.5% with a price to earnings ratio of 24 versus the international index at 2.3% and a price to earnings ratio of 17.3. So these are just more examples of how the valuation stacks up. Another point is that the international index has less tech exposure and more cyclical components, which can benefit in an economic rebound. The overseas markets are not as closely tied to the US election, or they're not as impacted by tensions between the US and China. And then some other supportive points for the international markets are the passing of the Euro Recovery Fund for COVID relief, as well as advances in automation and clean energy. So those are some supportive points for the international stocks. I'm going to turn it over now to David at this point, and he will discuss some specific ways you can add this exposure to your portfolio. David?
So thank you so much, Donna. So, Donna's made a great case as to why domestic has outperformed and why the baton may pass to international. And remember, we don't make big bets here. We're just suggesting that people perhaps rebalance their portfolios, shade a little bit more to what has underperformed, and that way there may be less volatility and less exposure in case some of those big cap techs take a big tumble, as they've seen this month. Indeed, Apple Computers down 25% just since the start of the September. So the easiest way to profit from a potential outperformance in international is to look at exchange traded fund. Why would that make sense? Because it gives you broad, diversified exposure to the potential asset class. So one that looks attractive, if the focus is on Europe, would be that iShares EFA. The EFA stands for Europe, Asia, overseas, so you get exposure worldwide except for the US. Down 4.2% this year, which has underperformed the overall market. A quick way to take advantage of some overseas outperformance. To add Japan to the mix, look at another iShares ETF product, the MSCI Japan, symbol EWJ. That's done a little bit better and certainly gives you inexpensive, convenient, quick, broad exposure to possible outperformance overseas. We also like the Vanguard Europe Exchange Trade Fund, VGK, down 5.4% this year. Now, if you have a larger portfolio, want to be a little bit more focused, three multinationals that we like would be Nestle's, Unilever, and BP. Nestle's is actually the largest consumer staples, what we eat and drink in the world, bigger than any US company. It is Swiss-based, does a lot of business, of course, in the United States, but also in Europe, Asia, and particularly has great exposure in the emerging markets. Size has its advantages. Nestle certainly has that. Unilever, also another consumer products name. Lots of food products that are delivered, for example, Skippy peanut butter, various soap and cleaning products in the United States, very well managed, based in London. And finally, BP. BP is, of course, an energy company. Interestingly enough, BP has more of its assets in the United States than Exxon does as a percentage of its operations. So, you ultimately perhaps get some domestic exposure, but you're paying less for it because BP trades at a significantly lower valuation than US energy companies. So now let's look at another asset class that has underperformed dramatically, and maybe an area where you want to add exposure to better diversify your portfolio, perhaps make more money, small caps. Now, historically, small caps are huge winners. If you go back to 1926, and you can see from this chart, the top line, a dollar invested in small caps ultimately grew over that very long period of time, over 100 years, or nearly 100 years, to over $16,000, while a dollar invested in large caps grew to just over $5,000. It's about 2% more per year. So certainly something that an investor saving for retirement, kids' education, whatever, can't overlook. So people say, well, what do we mean by small stocks? Well, small stocks are generally companies that have a market valuation up to about $3 billion as measured by market cap. What's market cap? Market cap is the number of shares that have been issued by a company times the current quote per share. That's how you measure it. Now, large caps would be 10 billion and up. How high is up? Well, recently over the summer, Apple hit 2 trillion, so they can get pretty big. So why would small stocks have this historically great record? Well, there is no extra reward without a little bit more risk. What do we mean by risk? More volatility. When people get nervous, they often tend to exit the small stocks in their portfolio so that it can be a little bit more up and down movement in exchange for that superior long-term return. They're often buyout targets. Small companies would not buy an Apple, and Apple might buy a smaller company. They're never bought at the last quote. They're always bought at a premium, and that can help spur returns for smaller stocks. Now, they're less liquid. So if you're running the Harvard Endowment, you've got so much money to put to work, you can't just allocate, you can't just buy 5% of a small company, because you'd have to buy so many small companies to make up your $40 billion endowment, you couldn't get enough of them. But for smaller investors, the liquidity shouldn't be a problem, and there's less competition from the big investors. That keeps them a little less expensive. And of course, there's more reward for rolling up your sleeves and really understanding what it is you're investing. Obviously, analysts tend to focus on the stocks with the most activity, the biggest stocks, less focus, less research on the little guys. That means there's more opportunity to do your own research, and you'll get paid for that. Now, although small caps, longer term, have done marvelously well, recently they have lagged. So we're looking here at a chart over the last 5 years, back to 2015, and the top blue line is the S&P, and the orangish line is the Russell 2000, which is widely viewed as an index proxy for small cap performance. And you can see substantial underperformance. Indeed, it's continued this year. Small companies have generated 14% less of a return this year, and they certainly got clobbered in March, living up to their extra volatility reputation, down 41% during the March drawdown, which was almost as bad as the sell-off seen in small caps during the dot-com crisis and the subprime crisis about 12 to 11 years ago. So again, what might be the catalyst for small caps to resume their historic outperformance? Well, first of all, valuation matters on many metrics. Price to earnings, price to sales, price to cash flow. Small companies are cheaper now than their larger cap brethren, particularly cheaper than those mega cap tech stocks. One of the tenets of the study, one thing that we learned from studying financial history, is that there is a tendency to reversion to the mean. So when one asset class outperforms, there's a period when it falls back into line and the underperformer takes the baton, as it were. So that's possibly what small caps are poised to do. Small caps are more domestically focused. So if you're skeptical of what we talked about in terms of international outperformance or less stressful, small caps might be your ticket because they have less overseas exposure. Now, one caveat to small caps is they tend to have less tech there, more exposure to financials, which with the low interest rates, concerns about the quality of loan portfolios for credit extended to Main Street, those financials have underperformed this year. So if you think ultimately that turns around, again, that might be a reason to shade that portfolio in the small cap direction. Any reason why small cap outperformance might be delayed. Yeah, there's such a focus on cloud computing, artificial intelligence, and as we pointed out, some of the trends affecting the financials, low interest rates may not end anytime soon. Some of the small caps include small energy companies, and of course, energy is out of favor now. So if you like the small cap idea, how do you play it? One chart that's kind of interesting here shows the relative performance from US small cap value. So these are smaller companies that trade at lower metrics of valuation compared to some of those large cap growth names, including those mega cap tech stocks that Donna talked about earlier. And you can see how small cap value has dramatically underperformed in recent years. But if we are right that there's ultimately a reversion to the mean and the mega caps pull back and people start looking for other areas to add to their portfolio, how do you play it? We love a trio of offerings from Vanguard. You've got their small cap index fund, very low cost, broad diversification, gives you immediate exposure to the area that's been out of favor in hopes of a rebound. If you're concerned about your taxes, they also have a small cap offering which tries to do what we do with individual stocks, which is to make sure that you're not handed a big tax bill by other investors going in and out of the fund. And if you agree that not only small caps, but so-called value stocks that are smaller make sense because their time to shine may be around the corner, then the Vanguard Small Cap Value ETF VBR. So speaking of value stocks, this is a third group which has been out of favor, done well historically, and you can see from this chart. This chart shows you value versus growth going back again to that 1926 start point when many statistics are widely available. And up through 2007, admittedly with some volatility during the dot-com boom in the late 90s, value stocks have continued to outperform their larger brethren. People say, well, what do you mean, Dave, by value stocks? Well, basically, it's a measurement of how much an investor gets in terms of each dollar of investment outlay of earnings, of revenues, of cash flow. They're also looking at how expensive it is relative to book value. The cheaper it is relative to the book value, the more value it is. Now, why would people pay more? Well, they might pay more saying, well, it's cheap, but 5 years down the road, the earnings and revenues and cash flow and book value will be much greater. So I'll pay more now in exchange for 2 or 3 in the bush down the road. So is this the time that value starts to get back on its horse and outperform? Some people think absolutely. Why? Because the discrepancy between what you're paying in terms of earnings for value stocks has gotten too big relative to those price to earnings metrics that Donna cited earlier for the large cap techs. Also, right now, low interest rates have made earnings to be generated 5, 10, 15 years down the road much more attractive because the so-called discount value, what you can do, is very low, which makes their present value much higher. But again, if we agree that interest rates are cyclical and there's a reversion to a mean, if interest rates start to go up, people may be more attracted to current earnings and current dividends. The other thing, as Donna mentioned earlier, the recent tech winners may have a target on their back by governments, not just in this country, but really worldwide, as they're looking for the Apples and Googles and Amazons. Are they exercise monopoly power? Should that be restrained? And as governments around the world are trying to pay the bills, particularly given the pandemic expenses, looking for ways to raise taxes, and certainly higher taxes might hit those very profitable large cap techs very, very hard. So how do you play it? Well, since we're not restricted to small stocks, you might consider buying value stocks directly. That's what we like to do here at Point View, because it gives us the most transparency as to what we own, the most control of the turnover, and of course, we're not paying fees to third-party funds. We always advocate spreading our investments over many different sectors. So in the financials, some of the leaders, probably the best one is JP Morgan, led by Jamie Dimon. That stock was around 140 at the start of the year. Now it's in the 90s. So if it just gets back up to where it started the year over the next 4 to 5 years, plus a nice dividend, that could be a profitable holding relative to many other things. MetLife is one of the country's top insurance companies. Again, is down 20–25% just since the start of the year. If it recovers that in the next few years with a vaccine being found, that looks good. In energy, it's been a tough area, but they say the best cure for low energy prices are low energy prices. Exxon's down 50% this year. Chevron's down 40%. Both pay big dividends. Those dividends may be reduced, but still is better than a non-dividend overpriced growth stock. In tech, got to have tech today. We love Intel, which has an above average dividend, is involved with chips for all sectors of technology. Cisco, of course, didn't pay dividends 20 years ago. It's gotten the dividend religion. Those dividends have been increasing at a double-digit percentage. So that would be good for those looking for income. Telecom, Verizon, we can't live our lives without having Verizon on our cell phones for many of us. Industrials, Raytheon looks good. It's a little out of favor because it does have exposure to the aviation industry, but we think that ultimately gets back on its feet. REITs have been tossed out, but we think they're kind of babies tossed out with the bathwater. Equity residential is down double-digit percentages this year. One of the country's largest owner of apartments, offering a 4% plus dividend, very well managed. Healthcare, Pfizer has teamed up recently with a German biotech. They may ultimately have the solution for the dearth of a good vaccine here. While you're waiting for some good news, enjoy a near 4% dividend on Pfizer, tremendous management. Consumer staples, well, they say when we're celebrating, we might have a beverage. When we're consoling ourselves with how long we've been locked up with the pandemic, we may be having a beverage as well. Anheuser-Busch has you covered. They own Budweiser, of course. They're one of the largest consumer staples companies in the world, controlling 5 of the top 10 beer brands and now getting into the so-called hard seltzer business. Meanwhile, utilities, First Energy has close to a 6% dividend, controlling the distribution of electricity from the Midwest to the East Coast. Utilities have been out of favor. You would think with the low interest rates, people are chasing the good dividend paying utilities. Not so far this year, but they may yet get back to the utilities. First Energy would be a good play in that area. So what's the bottom line here? We're just trying to give ideas. You never want to place a big bet on any investment idea, any asset class. Valuation, while it tells you what is inexpensive and out of favor, is not a great timing tool. Things can stay out of favor for many, many years. No guarantee that any one asset class takes that baton and races to the top of the chart that Donna shared with us earlier. So that's one thing to keep in mind. Another thing is that, again, more reward, more risk. Value stocks, small cap stocks, international, historically have been more volatile. If there is some sort of a crisis or so forth, people come back to the large companies that they know and love throughout these asset classes, but you historically have gotten paid for taking that volatility. And again, we think that this may be the time, if your portfolio has gotten too overweighted in some of those mega cap tech stocks, to rebalance, rediversify, and these might be good ways to do that. So at this point, what we'd like to do is handle some questions here. You've been patient. Let's get to some questions. Let's see what we've got here. Donna, here's one for you. Does it make sense to stay invested in light of a possible non-decision on election day?
That question, I'm sure, is on everybody's mind these days. A non-decision probably would be the worst outcome that we could have, but certainly a possibility. However, we would really not recommend pulling out of the market or staying on the sidelines right ahead of the election. People who wanted to do this at the last election would have, definitely hurt their portfolio. So we just recommend to be diversified. Again, as David said, not placing any big bets for sure, but stay in the market, stay diversified, and hold on tight, I guess.
Yeah, absolutely. So now we've got a question, maybe I'll field this one. Aren't small caps more challenged by the pandemic? Less resources, tech, and online presence. So, absolutely. I think that there's never been a point in history when you weren't better off facing the future with more resources. Yet, as we know, going back to 1926, despite the fact that small caps always have less resources than larger companies, they seem to have outperformed. I think one of the answers to that question is that an observation that's not unknown to the market? So, what's interesting about investing is not necessarily looking at the fundamentals, but also looking at what has been handicapped in terms of stock market prices. So I think one of the reasons people have sold off small stocks and said, notwithstanding their long-term superior track record, we're not going to own them, we're going to sell them. So what you have now is lower prices for the small stocks because of these challenges. So the reason to nevertheless be optimistic is saying, well, because I'm paying a lower price relative to history and relative to these large caps, if they continue to struggle versus the pandemic and having a little bit less technology, my downside might be less than, heck, will the pandemic ever end? I don't think anyone's saying that it will never end. So who knows, maybe Pfizer comes up with an announcement in the next month. I think the US government has already prepaid for some of their vaccines to be delivered before the end of the year. If all of a sudden the pandemic becomes less of a concern, we have better testing and vaccines at hand, maybe the small caps respond more favorably to that because they're the ones that were more challenged. At the end of the day, stay diversified, but that would be the case to proceed, notwithstanding the lesser resources. Here's one, maybe Donna, you want to field this one. How much should you invest overseas relative to domestic? You're muted, Donna.
The first piece I think you want to look at is how much that you are comfortable investing in equities. You certainly don't want to, keep your current, if your current equity allocation is say 70%, you don't want to add this international exposure on top of that 70%. So first thing you want to do is figure out what your equity target is overall, and then carve out a part of that to international. So, it really does depend on the investor, their time horizon, maybe 20-25% to start out. And like I said, I would maybe add more to that if you were a younger investor with a longer time horizon, and maybe, pull it back a little bit if you had a shorter time horizon.
Great, thank you. So we've got a question from one viewer asking about the regional banks. Well, the regional banks have been clobbered this year. Indeed, the KBW banking index is down 38% since the start of the year. It's the widest disparity between the overall market and that particular sector that's ever been seen in 85 years. So if you're a contrarian, that would suggest a lot of pain has been priced in to that area. But nevertheless, again, we talked about just because something is cheap or underperformed doesn't mean it's automatically going to make a V-shaped recovery here. So what are some of the challenges for the regional banks? I would say number one is a challenge faced by all the banks, which is the very low interest rates. When you think about what's the number one product of banks, is making a loan, whether to any of us here to buy a home, to finance an education, to buy an automobile, whatever. And the price of the loan, if it's a good time to borrow to buy a house, it's a bad time to lend money to let you buy a house. And so that's what the banks are up against, these very low interest rates. When is that going to change? Well, history would suggest eventually it'll change, that inflation will perk up and the pandemic will pass and interest rates will start to rise again, but we don't know when. The other problem, of course, is the regional banks, the smaller the banks, the more loans to Main Street America. And although some of the very large cap techs have done well because they're providing the services and technology we need to be productive from home and live our lives from our homes, Main Street, of course, is hurting badly because of the earlier lockdowns and now capacity limits and people being afraid to fully engaged in the world. And so many of those Main Street loans are under pressure as to whether they can repay them. Well, if they can't be repaid, then the regional banks' value of their loan portfolio is called into question. So again, it all comes back to this pandemic and the outlook for testing and the outlook for a vaccine. If you're more optimistic that that's going to come sooner rather than what Wall Street or most of America thinks, maybe this is the time to dip your toe in that water. If you're very pessimistic, maybe you hold back a little bit. The other thing, there was a good article in the Wall Street Journal today which talked about how some areas of banking are doing really well. That would include trading. Bond desks have been super busy. Stock desks have been super busy with trading. And also investment banking has been busy with the SPACs, the IPOs, M&A activity. But the smaller the bank, the less exposed they are to those activities, the more exposed they are to traditional banking areas. So that might be another reason that the smaller the regional bank anyway, the more cautious you might want to be. But I think longer term, it's a good idea, but whether that happens before the end of the year, certainly not clear. Donna, do we have time for one more question?
Well, you need to share the poll question.
Okay, that's right. Let's go right to the poll question. We're kind of exceeding our time allotment here. So let me bring up and share the poll results. In fact, Donna, do you have them up?
I can pull them up here. Okay, so yes, I have the results here. And interestingly enough, the asset class, which everyone thinks has the most value, is large cap. So I don't know if we didn't do a good job convincing that it was overvalued. We have 42% saying large cap has the most value. And tied for second, international and small cap at 26% and 5% at REITs.
Great, thank you. So maybe our last message is to buy REITs because no one likes them if you want to be contrarian. They certainly have the bigger dividends. But in any event, we do urge you to stay diversified, stay open-minded, stay the course, and on behalf of Donna, the whole team at PointView here, we want to thank you for attending our webinar. Remember, if you'd like a complimentary copy of these slides, just give us a holler. If you'd like a complimentary meeting to review what you're doing with your portfolio, again, just reach out. Thank you again for watching. Have a great day.
Thank you.